Spoiler alert, billion-dollar profits don't just disappear unless you know how to vanish them. This episode shows you how they pull the Houdini. All right, folks, strap in, because we're about to embark on a journey where we take a look at the smoothest, slickest, and most clever ways the big dogs make their money disappear. That's right, we're talking about hiding cash and making it vanish right under the IRS's nose. You see, there's a reason the big corporations keep getting bigger, and the little guys, well, they don't. Phil, it's not just hard work. It's hard to detect legal financial maneuvers that let the billion-dollar profits just fade into the background. Let's be clear, we're not talking about some back alley, off-the-record dealings. Oh, no. The best in the game don't leave anything to chance. They're playing with a full deck, but it's a deck of corporate accounting tricks that would make a magician look like an amateur. But before we get into it, go ahead and hit that like button, because if you're not liking this, you're clearly missing out on the insider playbook of the rich and powerful. And if you're really digging it, don't forget to subscribe. We've got a lot more dirty laundry to air in future episodes. So how do the big boys make their profits vanish, you ask? Well, my friend, welcome to the fine art of creative accounting. Don't worry, you won't need to be a CPA to understand this. I'm here to break it down in Saul Goodman-style. Simple, slick, and ready for your next money-making move. Step 1, the hidden cost of allocations. Now, let's talk about the first trick in the book, allocating costs. It's all about splitting things up and making them look like they belong somewhere else. Here's how it works. A large corporation might have billions in revenue, but that doesn't mean they're just tossing money around like a kid at a candy store. No, they've got an army of accountants working overtime to allocate expenses in such a way that the profits seem, well, smaller. For example, take a look at a big tech company. Let's say they made $1 billion last year. That's great, but oh wait, they also spent $900 million, 0 cents, in research and development, R&D. $50 million, 0 cents in advertising, and another $20 million, 0 cents in overheads for their international expansion. And that's just the tip of the iceberg. Suddenly, you're looking at profits that seem practically non-existent. But here's the catch. They didn't actually lose that money. No, they just allocated it away from their balance sheet to another part of their financial report, masking it from public view. It's all perfectly legal, by the way, as long as you're following GAAP, generally accepted accounting principles, but it's a game. You think they're spending all that R&D money? Well, some of that might just be a little creative accounting, splitting expenses across different divisions and writing them off in ways that make it look like the company's barely scraping by. Step 2, the offshore trick. But wait, this is where things get really fun. Once you've mastered the art of allocating costs, you move on to the next big trick, offshore tax havens. If you've ever heard of a Swiss bank account, you're on the right track. Here's the deal. The US government has a high corporate tax rate. It's no secret. But what if, just what if, you could earn your profits in a country where the tax rate is, let's say, much lower, maybe even 0? A lot of big companies do exactly that. They set up shell companies or subsidiaries in tax-friendly countries like Bermuda, the Cayman Islands, or Luxembourg, and route their profits through those locations. Sure, they may have a headquarters in the US, but their money, it's out of sight, stashed in tax havens where Uncle Sam can't touch it. And here's the kicker. When a US company sells something, the profit usually goes to the country where it was made. So if they can show that a sale was made by their subsidiary in, say, the Bahamas, they're legally avoiding US taxes. The whole thing is set up to make the money disappear before it even hits the IRS's radar. Again, this is all perfectly legal as long as the company isn't doing anything fraudulent or breaking international tax law. It's all about smart structuring, PPP. Tax code manipulation at its finest. Now, I know what you're thinking. What about the IRS? Aren't they onto this by now? Well, don't worry. The IRS tries to keep up with these offshore schemes. But the truth is, these companies are a step ahead. They have legions of top-tier accountants and lawyers making sure everything looks above board. They've got a legal army backing them up. creating paper trails and using every loophole in the book. And when the IRS gets close, these companies pull the rug out from under them with some next level legal defenses. On 3, the transfer pricing masterstroke. And then we have transfer pricing. This one's a beauty. Picture this. You're a multinational corporation with branches in different countries, right? Now, let's say you're selling a product in one country, but the cost of producing that product is being charged to another country where the tax rate is lower. You're shifting profits, making your operation look way less profitable than it really is. Here's an example. A big company has a subsidiary in Ireland where the corporate tax rate is lower than in the US. They charge the subsidiary $500.00 for a product that costs $100.00 to make. That's right, the price gets inflated so the subsidiary ends up with a large chunk of the profit, which they'll pay less tax on. The result? The company can shift profits away from the higher tax countries to those with lower taxes. Like a game of financial chess, this strategy helps corporations evade paying their fair share while appearing perfectly legal. The key to transfer pricing is documentation. You need to show that the prices you're charging are fair and consistent with what the market would charge. But when you've got a top-notch accounting team and the right legal advice, there's no limit to how far you can take it. Step 4, the depreciation dance. Oh, and let's not forget depreciation. We've all heard about it, but have you ever really understood how it works? Here's the deal. Depreciation allows companies to write off the cost of their assets over time, instead of taking a huge hit all at once. But here's the catch. If you've got a massive asset like real estate or machinery, you can write off that asset's value over several years. The key here is to maximize the depreciation in the first few years to reduce taxable income. What's great about depreciation is that it's a non-cash expense. This means a company can claim the deduction without actually spending any cash. It's like a free pass to reduce your taxes, all while the asset is still being used and earning money. Companies that know how to manipulate this strategy will often create massive depreciation schedules to make their profits appear smaller than they are. But don't worry, those assets are still putting money in their pockets, and over time, the company can write off a large chunk of their taxable income. Step 5, the debt game. Finally, let's talk about debt. Everyone thinks that debt is a bad thing, right? But in the world of big corporations, debt is a tool for reducing taxes. Companies can take on debt and deduct the interest they pay on it. Now, you may think, hey, if I'm taking on debt, I'm just digging myself deeper into the hole. Not so fast, my friend. The bigger the debt, the bigger the deductions, and the more the company can keep its tax bill low. That's the beauty of debt. It's a tax shield. As long as companies are making money, they can deduct the interest payments they make on loans and use that to offset their taxable income. So by leveraging debt, they lower their tax bill without actually sacrificing much. It's the corporate version of using someone else's money to make your own life easier. So there you have it. You've just learned how the big corporations and the billionaires play their game and make their profits vanish without a trace. They're not just using these strategies to save a few bucks. They're using them to build empires, evade taxes, and keep the IRS from breathing down their necks. These are the tricks of the trade, and they're all perfectly legal as long as they're done right. And you, yes, you could use some of these strategies for yourself if you know what you're doing. But let me tell you, don't try this at home without a good lawyer. This is some next level, high stakes stuff, and you better have your paperwork tighter than a drum if you're going to try it. Remember, when it comes to taxes, it's not about playing by the rules. It's about bending the rules until they break. Want more tax tips, loopholes, and financial magic from yours truly? Well, you know what to do. Smash that like button, hit subscribe, and stay tuned, because the next episode is going to be even juicier, and trust me, you don't want to miss it. Better call Saul.